Welcome to the deep dive. Looks like someone's ready to conquer the world of investing. I'm seeing a whole stack of books and articles here, especially from John Bogle. That's a pretty solid choice. He's like a legend in the field.
Yeah, John Bogle. Definitely a pioneer.
So, ready to get to the heart of smart investing. Like a 10-point cheat sheet to help you navigate this whole thing.
Absolutely. And sometimes those key points can be a bit hidden, like trying to find a needle in a haystack, especially with all the information and different opinions out there about investing. So, yeah, we'll try to break it down, make it clear what really matters.
Okay, let's jump right in. One thing that really struck me was Bogle's Gottschalk's family analogy in the little book of common sense investing. It's so simple, but so smart. How he shows a trap that so many investors fall into.
Yeah, it's crazy how we can overcomplicate investing.
Right.
So basic. This family owns every business in town, sharing all the profits. Then they start trading shares among themselves and bring in all these helpers.
And that's where it gets interesting. These helpers, brokers, advisors, all those guys, they start taking their cut. And suddenly the family's wealth is shrinking. Not because the businesses are doing badly, but because of all the extra costs and fees.
Yeah, they invited all these extra expenses. It's such a good way to show how all the trading and fees can actually make your return smaller. Actively investing can be less profitable than just keeping it simple.
So simple, but powerful.
Yeah.
Don't let extra steps eat away at your returns. Always think, are these helpers actually adding value? Or are they just taking their share? You know what I mean?
Such a good point. It's something you should always ask yourself when you're looking at any investment. And this takes us to another thing Bogle talks about, a really important difference. Investment return versus speculative return.
I've heard those terms thrown around. But sometimes I'm like, wait, what's the difference again? Investment return seems pretty clear though, right? You earn from how the actual businesses grow, dividends and all that.
Right, you own a part of a company, and if they do well, you benefit. Simple. But then there's speculative return. Yeah, that's a whole other thing.
A little less predictable, to say the least. This is where things get interesting and maybe a little risky.
It's all about how people see the market, feeling, and just pure emotion.
Like all those hot stock tips you hear,
Yeah.
right? Or market bubbles.
Yeah.
Everyone jumps in, prices go up. But it's not always based on how good the companies really are.
Exactly. Not based on the fundamentals.
And Bogle even shows some numbers in Exhibit 2.1, right? Showing how speculative return can create those wild swings in the market. But what does it all mean in the end? What's the takeaway from all that data?
It's all about the long term. The real wealth comes from steady, reliable investment return. Those big swings are tempting, yeah, but they can also be really dangerous if you're not careful.
It's like Bogle says, the market is a voting machine in the short term and a weighing machine in the long term. Short term, it's all about popularity, but long term, it's about what really has value.
Yeah, true value. So for your 10-point cheat sheet, focus on the business. How strong are they? How much potential do they have to grow? Are they making money, paying dividends? Don't get caught up in the hype.
Speaking of long-term growth and not falling for hype, Bogle's known for, index funds. And it's pretty amazing how his own experiences led him to create the world's first index fund, the Vanguard 500 Index Fund, back in 1976.
1976, wow, that's a long time ago. He was definitely ahead of the curve.
Yeah.
And look at it now. Amazing performance, delivering those steady market returns with super low fees.
Like a perfect example of walking the walk. And he even tells this story about a lawyer who put just $15,000 in that first Vanguard Index Fund.
And by 2016, it was over $900,000.
Wow.
That's the power of compounding over time and keeping those fees low so more of that money stays in your pocket.
Okay, let's talk about those fees. They seem to be like a real thing for Bogle. He's not a big fan of all those costs, right? What's the deal with actively managed funds and index funds when it comes to how much they cost?
Okay, so actively managed funds, they have those portfolio managers, right? They're buying and selling all the time, trying to beat the market, but all that activity costs money. Transaction fees, research costs, and of course the manager's salaries. And guess who ends up paying?
The investors.
Exactly. Those costs become higher expense ratios.
And those higher expenses, they can really chip away at your returns over the long haul.
Bogle brings up some pretty convincing evidence in the little book of common sense investing. He talks about those SPIV reports, right? The ones that compare how actively managed funds do against their benchmark indexes.
Yeah. The SUV reports, they don't lie. Over a long time, most actively managed funds actually do worse than the benchmarks they're trying to beat. Like Exhibit 3.3 shows that from 2001 to 2016, over 90% of large-cap U.S. equity funds didn't beat the S&P 500.
90%. That's crazy. So are you saying trying to pick individual stocks or time the market is basically a losing game? Well, not always. But the odds are definitely not in your favor. And even if you find a winning fund one year, there's no guarantee it'll keep winning. Consistency, that's what matters, and that's where index funds really shine. It's like impossible to predict. The market, I mean, always changing. Even the pros have trouble keeping up.
So for our 10-point cheat sheet, we've got stick with low-cost index funds. That's
Yeah.
got to be a top contender, right?
Definitely a core principle for long-term investing, yeah.
Yeah.
But a good portfolio usually needs a bit more than just stocks.
Right. Bonds. They're the safe part, supposedly,
Yeah.
bringing some stability to the table when the market goes crazy.
Exactly. Less volatile than stocks, that's for sure. They're key for managing risk, and they can even generate some income, especially as you get closer to retirement.
Bogle even says that bonds have actually outperformed stocks over certain periods.
In Chapter 14 of the Little Book of Common Sense Investing. Surprising, right? It's true. Especially when interest rates are dropping. History's on their side, solid returns, but gotta be careful, just like any investment. Lots to consider when picking bond funds.
Like what? What should we watch out for?
Maturity is a big one. Bonds with longer maturities, they're more sensitive to interest rate changes. So if you're worried about rising rates, maybe go for shorter-term bond funds.
Makes sense. What about the types of bonds in a fund? Bogle talks about high-yield bonds, someone called junk bonds. Sounds a bit riskier.
Yeah, they are. Issued by companies with not so great credit ratings, so higher risk of default, Higher yields, though, to make up for it. But gotta be okay with that risk.
So again, balancing risk and reward. Just like with stocks, fees too, right? Still got to be mindful of those.
Oh, absolutely. Just like with stock funds, the fees for bond funds can be all over the place. Compare costs, choose funds that fit your risk tolerance and what you're trying to achieve.
Speaking of choices, ETFs, exchange-traded funds, super popular lately. What's the draw?
They're really flexible. Trade on exchanges like stocks, so you can buy and sell throughout the day. Plus, they cover, like, everything. Broad market indexes, specific sectors, even commodities.
So convenience and diversification sounds pretty good, but Bogle seems a bit cautious about them in his book, The Clash of the Cultures. Why the hesitation?
He's not totally against them, he sees the benefits, but he's worried about how they can be misused. He says they make it too easy to trade, which tempts people to speculate in the short term, and that usually leads to bad performance.
Yeah, the buy low, sell high dream. So tempting, but so hard to actually pull off.
Right. And he also doesn't love all those smart beta ETFs, the ones that claim they can beat the market with their fancy algorithms and stuff.
They do sound pretty sophisticated, but maybe not all they're cracked up to be.
That's what Bogle thinks. He says they often end up holding a lot of the same stocks as regular index funds, but charge more in fees. He calls them expensive closet index funds.
So once again, complexity in marketing, hiding potential problems. People really got to do their research.
Look past the fancy names and marketing. See what they're really holding. Check the fees. Look at their long-term track record before you jump into any ETF.
So another point for our cheat sheet. Be wary of short-term trading and the hype of smart beta ETFs.
For sure. Okay, so now you've got a good idea of the different types of investments out there. The next big question is, how do you split up your money? Asset allocation, stocks versus bonds. What's the right balance?
$1 million question. And the answer, as always, it depends. But seriously, any rules of thumb we can use? Any guiding principles?
There are, yeah. Your ideal asset allocation depends on you, your risk tolerance, how long you're investing for, and of course, what you're trying to achieve with your money.
So that's the it depends part.
Nick.
But Bogle, he's got some helpful frameworks, right? Like your bond allocation should match your age. Older you are, more bonds you need for stability.
That's a classic one, but not always the best approach. Bogle actually changed his mind about this, even created some new funds to address how things were changing for investors.
Okay, now I'm really curious. What were these new funds? And what made Bogle change his thinking?
So in 1994, Vanguard launched life strategy funds. They offered different mixes of stocks and bonds to match different risk profiles. You could go 80% stocks, 60%, all the way down to 20%. He realized that a fixed allocation just wasn't right for everyone.
So recognizing that things change, people's needs, risk tolerance, all that, What else was new about these funds?
He also added international stocks and bonds to the mix. Global markets, he saw they were becoming more and more important, kind of a shift from his earlier focus on just U.S. markets.
So an evolution in his thinking, more open to global diversification. We didn't even talk much about that yet.
Yeah, that's a whole other conversation. And building on this idea of mashing investments to different life stages, we see the rise of target date funds, TDFs.
Yeah. TDFs. They're everywhere these days, especially for retirement planning. They automatically adjust your asset allocation as you get closer to retirement. Yeah. More conservative over time.
Like having a financial autopilot. But even with these set it and forget it options, Bogle still says due diligence is key.
Right. He's always saying, look under the hood. Don't just trust the name. Understand what's in it, the fees, the strategy.
Exactly. And with TDFs, he's especially cautious about the actively managed ones. Higher expenses than the index fund-based ones.
There it is again. Costs matter. Even with something like TDFs, got to keep an eye on those fees.
Absolutely. And when we're talking retirement planning, Bogle reminds us not to forget about, well, Social Security. It can be a big part of your retirement income.
Right. It's often seen as like a safety net, but it can actually be a pretty valuable asset in retirement. How does Bogle suggest we think about it?
He's got this kind of unique way of looking at it. Think of Social Security like a bond, he says. Steady income, right? So you might not need to be so super conservative with your other investments.
Makes sense. If you've got that guaranteed income, you might be able to put more into stocks for growth without taking on too much risk.
Exactly. Optimize that portfolio for the long haul.
You know, it's interesting. This keeps coming up in Bogle's work, like a broken record, but in a good way. Fees, fees, fees. He's always talking about how much those fees matter.
Yeah, people don't realize they seem small, but over time, big impact.
He even gives this example in the Little Book of Common Sense Investing, right? A low-cost portfolio can actually do better than a higher risk, higher cost one over the same period, even with less money in stocks.
Tyranny of compounding costs, he calls it. Those fees just eat away at your gains year after year.
So it's not just about chasing the highest returns. It's about keeping more of what you earn. Which brings us back to index funds, I guess. Low costs, let that compounding do its thing.
Right on. And when it comes to retirement planning, Bogle's got a really helpful breakdown of all the different options. 401k, traditional IRAs, Roth IRAs. He explains it all, like which one might be best for you, the tax stuff, how much you can contribute.
He even goes into Roth IRAs. You put in money that's already been taxed, but then when you take it out in retirement, it's tax-free.
Yeah, it's like pay taxes now, enjoy tax-free income later.
Trade-offs, trade-offs.
Yeah.
He even talks about converting an existing IRA to a Roth, but that's a whole other thing. Probably need some expert advice for that one.
Definitely. Lots of tax implications to consider.
So we've talked about accumulating wealth, but as we get closer to retirement, it's all about generating income, right? Making sure your savings last.
Exactly. Bogle's got this total return approach, using dividends and some regular withdrawals to create a steady stream of income each month.
Like building your own personal pension plan. He even mentions that rule of thumb, the 4% withdrawal rate, taking out 4% of your starting retirement savings each year and adjusting for inflation.
It's a good guideline, yeah. But like he always says, no guarantees. Retirement planning, it's tricky. Lots of moving parts. Best to talk to a financial advisor. Get a plan that really fits your situation.
So much to think about. But before we wrap up, let's try to boil all this Bogle wisdom down to that 10-point cheat sheet we talked about. What are the key takeaways here?
Okay, here's what I've got. From our deep dive into Bogle's world, keep investing simple. Avoid unnecessary costs and complexity. Gottschalk's family, remember? Stick to the basics. Focus on the long term. Don't get caught up in the day-to-day market noise or those crazy speculative bubbles. Invest for slow and steady growth. Embrace low-cost index funds. They give you exposure to the whole market, keep those fees down, and deliver solid market returns consistently. Be wary of active management. Most of them can't even beat their benchmark indexes because of all those extra costs. Diversify, diversify, diversify. Spread that risk around. Different asset classes, sectors, and don't forget about global markets. Consider bonds for stability. They're less volatile, and they can provide some nice income and diversification for your portfolio. Understand those fees. Pay attention. Expense ratios, transaction costs, all those hidden fees that eat away at your returns. Tailor your asset allocation. Figure out the right mix of stocks and bonds for you, based on your risk tolerance, how long you're investing for, and of course, your financial goals. Plan for retirement early. Start early. Time is your friend. Take advantage of that compounding power And look into those tax-advantaged retirement plans like 401ks and IRAs. Stay informed and adapt. Keep learning about investing and adjust your strategy as you go. Life changes. Markets change. Be ready.
There it is, your 10-point cheat sheet, straight from the mind of John Bogle.
Yeah.
Make smart choices. Stay disciplined. And remember, it's a long game.
Couldn't have said it better. Investing doesn't have to be complicated. It can be simple. Almost anyone can do it. Just follow these principles, build a solid foundation, and you're on your way to financial success.
One last thought. Bogle, he talks a lot about dividends, how important they are for long-term returns, especially for people in or near retirement. So keep that in mind as you continue your investing journey. Think about how a focus on those dividend-paying stocks, maybe within an index fund strategy, could really boost your portfolio and provide that steady income stream you might need later on. Happy investing, everyone.